Hi, my name is Trevor Gravink, and I'm here to talk to you about the pros and cons of bank statement mortgage loans and to see if it's right for you. Now, I'm a mortgage broker. I've done plenty of these loans, and I can go through the different options with you to be able to see if it's most beneficial for you. And also, being a mortgage broker myself, I'm also self-employed, so I understand when it comes down to showing income on your taxes, it may not actually be how much income is actually coming into you. So let's go over how this might be beneficial for you. So a bank statement loan is going to allow you to be able to qualify based on the deposits going into your business checking account. And sometimes that can be multiple accounts. Instead of actually showing taxes, W-2s, pay stubs, all those other items that are usually standard for a conventional or FHA loan. Then what's going to happen is the actual lender is going to use an expense factor for your type of business. And that expense factor is going to determine how much of the actual deposits you'll be able to use as income to qualify for a housing payment. So when you apply for a bank statement loan, you're going to supply the lender with anywhere between 12 and 24 months of your most recent bank statements. They're going to calculate and figure out the verifiable deposits, and then they're going to give you an expense factor on the type of business that you run. So as a mortgage broker, real estate agent, without a lot of employees and a lot of overhead, they may make my expense factor 10%. Somebody running a restaurant with high overhead and a lot of employees, their expense factor might be 50%. So it's going to be dependent on what type of business that you run, how they determine that expense factor. So let's talk about the pros and cons of bank statement loans. And then what we'll do is we'll go into more detail about each one of these. So first of all, it's easier documentation. In most cases, you get approved for a higher loan amount if you have a decent amount of cash flow going through your bank accounts, but you take a lot of write-offs on your taxes. Bank statement lenders use common sense underwriting versus having to be able to be in the box of a conventional or an FHA loan, which is required to be able to use Fannie Mae and Freddie Mac's guidelines. And then because these are non-QM loans, there is no PMI or private mortgage insurance on these types of loans. If you're putting less than 20% down on a typical loan, you would have that PMI. Now, some of the cons of bank statement loans would be higher down payments required, higher credit scores, higher interest rates. Not all lenders offer bank statement loans, and typically reserves are required. So let's talk about the documentation requirements. Lenders are going to ask for anywhere between 12 and 24 months of your bank statements. If you supply 24 months, that's going to show the bank that you have a longer history of these deposits, so you'll get a slightly better rate if you supply 24 months versus 12 months. They're also going to ask for your LLC or corp documentation to be able to prove that you're the owner of the business and then what percentage owner you are of that business. So you're not going to have to supply any taxes because they're not going to go off your taxes. They're simply going to go off of the bank statements themselves. So if you're self-employed, you probably try to take as many write-offs as possible so that you can reduce your taxable income. However, conventional lenders must go off of the net income that shows on your taxes, so that can impact what you can qualify for when it comes to a mortgage. It doesn't show you the full picture of your ability to be able to pay back the loan, but because they're under Fannie Mae and Freddie Mac guidelines, they have to use a specific type calculation. With bank statement loans, they use 100% of the verifiable deposits that go into your checking account of the business. And sometimes it can be multiple businesses and multiple accounts. So let's talk about how income is calculated and go through a quick scenario. Let's say over a 12-month period, your business has $300,000 in verifiable deposits. The lender would take the $300,000, they would divide it by 12, and when you do that, you come out with $25,000 a month on average. If you own 100% of the business, you would be getting 100% of the verifiable deposits. However, if you only own 50% of the business, then they would take that $25,000 and they would cut it in half. Now, if your business expense ratio is 20%, then they're going to utilize 80% of the verifiable deposits as your qualifying income. So for this example, $25,000 times 80% would be $20,000. The $20,000 is what the lender would use for your income to be able to calculate your debt to income ratio to see what housing payment you qualify for. Now, like we talked about, they use common sense underwriting. With conventional loans, an underwriter must check off certain boxes and they must calculate your income using certain formulas. There are no exceptions. With a bank statement loan, there's more flexibility for the underwriter to be able to use to be able to see your ability to be able to repay back that loan. Since these loans are non-QM loans, they get more flexibility and potentially looking at what your credit score is, past credit events that have happened, or other factors that may normally get turned down by a conventional lender. Now, if you put down less than 20% on a conventional mortgage, you're going to have to pay PMI or private mortgage insurance. PMI can typically cost anywhere between a half point to 0.75 of the actual loan balance. The exact amount is going to be dependent on several different factors like your credit score, down payment, debt to income ratio, but on average, you can expect to pay anywhere between $30 to $70 on every $100,000 you finance. Now, if you're a first-time home buyer and you're buying a primary residence with conventional, you can put as little as 3% down. With FHA, you can put as little as 3.5% down. With bank statements, they do require a larger down payment. They'll do it as little as 10% down if you have a credit score that's 680 or higher. Now, there's plenty of different lenders that offer bank statement loans, so sometimes the credit score requirements do change. Currently, most lenders that I know are at 10% with the 680 credit score. Now, because bank statement loans are seen as a little bit riskier since they're not going off of your taxes, they do come with a higher interest rate. Now, given that you're self-employed and you're probably going with a bank statement route because you already take write-offs, this may be another write-off that you can take, the extra interest. So given all factors of the loan are the same, typically bank statement loans are going to have an interest rate about 1 point to 1.5 points higher than a conventional loan. Or for the same rate, it's going to cost anywhere between 2 to 3% in discount points. Discount points are basically prepaid interest that you pay up front. So if your loan amount is $300,000 and you need to pay 2% in points, you're looking at $6,000 in fees for the same rate as a conventional loan. Obviously, that's going to vary depending on different types of scenarios like what type of property, credit score, and other factors, but this is just an average for you. So on an FHA loan, you can qualify with 3.5% down with a credit score with at least 580. With a conventional loan, you can put as little as 3% down if your credit score is 620 or higher. However, with a bank statement loan, if you want to put 10% down, you have to have a credit score of 680 or higher. Now, some lenders do go below 680. I've seen lenders that go down to 620 or even lower on some exceptions, but typically they're going to want a larger down payment, anywhere between 25 to 35. Now, not all lenders offer non-QM loans, so your typical large bank, credit union, local bank may not offer this product. So if that's usually your go-to lender, that might not be an option for you. You must work with a lender that offers non-QM mortgages. Now, many non-QM lenders only work through mortgage brokers like myself. So it's best that you talk to somebody to see what your options are. And then in a lot of cases, like a mortgage broker like myself, what I can do is actually shop for the best bank statement lender for you for rates and fees. Usually reserves are not required. However, with bank statement loans, they are, because again, it's a slightly riskier loan for the lender. So what they're going to require for reserves is going to be dependent on a few factors such as your down payment and credit score. They're going to want anywhere between 6 to 12 months of the housing payment in reserves. Now, reserves are not something that you bring to the table or anything like that. So what this means, if your total payments, so principal, interest, taxes, homeowners insurance, and any association dues, let's just say that's $2,500 a month, and let's say the lender requires you to have 12 months in reserves, you must have an additional $30,000 in savings, checkings, or in a retirement account. Now, if you are using a retirement account for reserves, you need to check with the lender to see what percentage they'll allow. Sometimes they'll only use 70% of the funds in a retirement account, meaning that if you have $30,000 in there, they're only going to give you credit for $21,000. If you're unsure if a bank statement loan is right for you, it's best that you talk to a mortgage consultant. That way we can actually take a look at your taxes, and then we can also get your bank statements calculated, and we can show you, hey, if you utilize your taxes, this is your maximum loan amount. And then if we use your bank statements, here's your maximum loan amount. And so you might qualify for a lot more on the bank statements. However, the rate might be higher, so you may be more comfortable with a lower loan amount or bringing more money to the table. Every scenario is unique, so it's best that you talk to somebody that can present both options to you, so then you can make the best determination which route you want to take. Now, it's very simple to have your income calculated for your bank statements. All we need is 12 months of your most recent bank statements. We actually put that through AI. It verifies the deposits, and usually in one business day, we can come back with what income we can use based on your bank statements. Now, I would love to personally help you with your bank statement loan or any other financing needs when it comes to your mortgage. You You can see my client reviews if you go to Zillow or Google of many clients that I've helped, and I'd love to be able to help you and your family. Now, if you have additional questions about bank statement loans or other financing options, go ahead and give me an email at trevor@rebrokerbuddy.com or give me a call at 619-404-6637. And then all the information to be able to get a hold of me or schedule a consultation with me is below this video. You can just simply click on the links, get on my calendar, we could discuss your options. Truly appreciate your time, and if you like this video, go ahead and give it a like for me, please.